Most investors in India make one mistake. They think investing must be complicated. Dozens of stocks, constant market tracking, endless financial news. But the truth is very different. The wealthiest long-term investors often follow something incredibly simple. Just 3 funds, nothing more. No stock picking, no daily trading, no constant stress. A system that quietly builds wealth year after year, through market crashes, through bull markets, through economic cycles. And the surprising part is this: anyone can build this portfolio. A beginner, a salaried employee, a small business owner, even someone starting with just 5,000 rupees per month. You don't need market genius. You need structure, you need discipline, and you need patience. Today, I will show you the simple 3-fund portfolio used by disciplined investors around the world, adapted for Indian investors. Simple, powerful, and surprisingly effective over the long term. Because sometimes the best strategy is the one you can actually stick with. Disclaimer: this video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Understand the idea of simplicity. Most investors believe more funds means better diversification. But often the opposite happens. Too many funds, too much overlap, too much confusion. The 3-fund portfolio removes this complexity. 3 carefully chosen funds, each serving a clear role. Equity for growth, equity for broader diversification, debt for stability. That is the foundation. And once built, it requires very little maintenance.
Step 2. The first fund, a large-cap index fund. This fund tracks the largest companies in India, typically the Nifty 50 or Sensex index. Companies like Reliance, TCS, HDFC Bank, Infosys, these are the backbone of the Indian economy. Instead of trying to pick winning stocks, you simply own the entire index. Low cost, highly diversified, historically stable compared to smaller companies. Example: a beginner investing 10,000 rupees per month could allocate 4,000 rupees to a Nifty 50 index fund through SIP. Slow, consistent, market-driven growth. Step 3. The second fund, a total market or flexi equity fund. Large caps alone are stable but limited. India's fastest growth sometimes comes from mid-cap and small-cap companies. This fund captures that broader growth. More companies, more sectors, more opportunities, but also slightly higher volatility. This is where diversification becomes powerful. Example: allocation. From the same 10,000 monthly investment, 3,500 could go into this diversified equity fund through SIP. Over time, this portion may provide stronger growth, but it will also move up and down more aggressively. And that is normal. Market cycles are part of investing. Step 4. The third fund, a debt fund. This is where many beginners hesitate. They want maximum equity exposure, maximum returns, but stability matters. Debt funds provide balance. They invest in government bonds, corporate bonds, high-quality fixed income instruments. This portion reduces volatility in your portfolio. It acts like a stabilizer during market crashes. Example: allocation. From the same 10,000 monthly SIP, 2,500 goes into a short duration or corporate bond debt fund. During market downturns, this portion usually falls less than equities. Sometimes it may even remain stable. That psychological stability is important. It helps investors stay disciplined. Step 5. Understand asset allocation. Asset allocation is the real driver of long-term returns, not stock picking, not market timing. Allocation. A simple starting allocation for many Indian investors could be 40% large cap index fund, 35% diversified equity fund, 25% debt fund. This mix provides growth and stability, but allocations can change based on age, risk tolerance, financial goals. A 25-year-old investor may hold more equity. A 50-year-old investor may increase debt allocation. Strategy must evolve with life stages. Step 6. The power of SIP. Systematic investment plans remove emotional decision-making. You invest every month, regardless of market levels. Markets high, you invest. Markets crashing, you still invest. This creates rupee cost averaging. Over time, you buy units at different prices, which smooths market volatility. Example, $10,000 per month invested for 20 years, even with moderate returns, can potentially grow into several lakhs or more. The key is consistency, not timing the market. Step 7. Market cycles and risk. Markets do not move in straight lines. There will be crashes, corrections, bear markets. Fear will appear. News channels will panic. Friends will exit the market. But disciplined investors understand cycles. Short-term volatility, long-term growth. India's economy continues expanding. Population growth, technology adoption, infrastructure expansion. Over decades, equity markets reflect this growth. Patience becomes an advantage. Step 8. Rebalancing the portfolio. Over time, allocations change. Suppose equities grow rapidly during a bull market. Your equity portion might rise from 75% to 85%. Now your portfolio carries higher risk. Rebalancing corrects this. Once a year, you review allocations. If equities exceed target levels, you shift a portion into debt funds. If markets crash and equities fall below target, you move some debt back into equities. This disciplined process forces you to buy low and trim when markets are high, without emotional decisions. Step 9. Basic tax awareness. Taxes matter in long-term investing. Equity funds held longer than 1 year qualify for long-term capital gains tax, currently lower than short-term taxes. Debt funds may have different taxation depending on holding period and rules. Frequent buying and selling increases tax burden, which reduces net returns. Long-term investing helps reduce this impact. Another advantage of simplicity: fewer transactions, lower taxes, better compounding.
Step 10. Avoid common mistakes. Chasing hot funds. Switching strategies every year. Panic selling during crashes. Over-diversifying with too many funds. Checking portfolio every day. These behaviors destroy long-term returns. Successful investors follow boring systems. They automate SIPs, review occasionally, and ignore daily market noise. Discipline always beats excitement. Step 11. Scaling the portfolio. As income grows, investments grow. A young investor might start with $5,000 monthly SIP, later increase to $15,000, then $30,000, then $50,000. The structure remains the same, only the numbers grow. The three-fund system scales beautifully, no complexity required, just higher contribution levels and time. Step 12. The long-term mindset. True wealth is not built in months or even a few years. It is built over decades. Consistency compounds silently. Every SIP installment is a small brick. Each year, the structure grows stronger. Most investors fail because they stop early, not because the strategy failed. Time is the real multiplier, and discipline protects it. Wealth is rarely built through complexity. It is built through consistency, through structure, through patience. The simple three-fund portfolio is not exciting. It will not make headlines, but it can quietly build financial freedom month after month, year after year. While others chase the next hot investment, you follow a system, and systems win over emotions. One day, years from now, your future self may look back at these small SIP investments and feel grateful you started early. Calm decisions today, financial strength tomorrow.